Good afternoon, welcome to GrainTV. My name is Cody Bills. This is Logan Burgess. Today is September 14th, Friday, for the weekly wrap-up. Let's get right into fire tips, see where the grain markets closed here. Corn in December contract trading up 8 3/4, closing off the week at 782.5. We got November beans trading down 9 1/4. The only grain that actually went negative and closed about 10 cents to the downside here this Friday, closing off the week at 17.38. Wheat trading up 23 3/4, closing off at 9.25 3/4. In Kansas City, wheat also up 25 1/4, trading at 9.48. Logan, why did we see this? What drove the markets this morning?
You know, I think right off the get-go, it's kind of a continuation of yesterday's theme. We did have QE3 announced yesterday by Ben Bernanke. If we take a look here, you know, the dollar index traded sharply lower in today's action. We had crude oil pushing new highs. We had gold trading up sharply higher. The grains in general found a lot of support from QE3 announcement here. You know, one more thing that I think the trade was watching really closely early on in the session from a fundamental standpoint was some numbers that we saw come out from Landworth. As you can see here, expected production out of this corn crop for the 2012-13 crop is expected at 10.14 billion bushels. Soybeans here, 2.6 billion bushels. How does this compare to the USDA, what they came out with in the September WASDE report? Well, you can see here for corn, sharply lower than the 10.73 billion bushels that the USDA has this crop pegged at. I think that was kind of confirmation to a lot of people that saw that USDA production number on Wednesday, and also noted that they didn't adjust the harvested acreage number, thought that accordingly this production figure is well overstated. Just kind of confirmation of that sentiment in the market. I think that supported corn. If we take a look at where the funds are in this market right now, we did just get the commitment of traders report here this afternoon. Taking a look, the funds are still over 300,000 contracts net long in corn. Obviously, the funds are very comfortable with the upside potential of this market. No real indication that they are willing to leave this corn market or the soybean market in last week's action. Obviously, they're going to have to exit at some point. When they do, it's going to come under heavy selling pressure, but right now they're holding tight right now. You know, one interesting thing that you mentioned, Cody, was that we did have soybeans trading down about 10 cents while the rest of the grains were moving higher here. What's kind of your take on this bean market right now? You know, after kind of a weak trade on Friday?
Well, I think relative weakness within the grain complex, especially when you had the bullish report that we saw on Wednesday. You had Ben Bernanke come out with quantitative easing on Thursday, and Friday we trade down. We're the only grain that trades down. And honestly, this is a red flag to producers out there. Guys, I don't like this. It doesn't make me feel comfortable. I'm concerned here. It kind of has the feeling of a little bit of a toppy nature to it. Now, I'm not saying that we are going to sell off, but I'm saying you guys should be prepared in case it actually happens. In case, I mean, we've been looking at this thing go straight up for a very long period of time. We had some consolidation back in July, but honestly, I'm a little bit concerned here. So if we fall below, and this is what I'm looking at for a stop here. If we fall below this previous high that was set, it's at 16.91, which is the previous high. If we fall below 17 and we close below 16.91, I think there's a very good chance that we could see some unwinding and some a pretty sharp decline in prices. Now, I'm not saying that over the long term that I'm not bullish over soybeans. I'm saying you got to protect yourselves when it looks when everything looks great, when it looks the bullish picture is as clear as it's ever been. Protect yourself, because that's when you seem to get these sell-offs and it catches people by surprise, and you don't want to be selling out of fear. Have a plan.
Right, absolutely. Well, if if we look at the spreads that kind of how they were moving today, we did see that front month November contract now trading down about 10 cents here. If we go out to the more deferred months, we actually saw those contracts trading higher. So we had this huge inverted market. You know, a couple weeks ago here, it was near $2 a bushel when comparing November to July 13. Just in today's action, we saw that narrow here about 15 cents. Obviously, right now, this market is still screaming for producers to sell this soybean crop right off the combine. We've been talking about that here for a while, but it looks like this premium built into the new crop contract may be waning a little bit here. For producers out there that are looking at making harvest sales here, Cody, obviously basis is a huge component of any grain sale. I know you looked at that earlier today. What are we kind of looking at there? What's the market telling us?
Yeah, well, this week, basically, we saw basis declined about 9 cents. For soybeans in the spot months across the average across the U.S.
Right.
We saw corn basis decline about 3 cents. I think there's a number of different reasons why we're seeing basis continue to decline very sharply. Number one, harvest pressure. We're 15% harvested here for corn. We're 3% or 4% actually harvested for soybeans.
Right.
We got softening Gulf basis, so we didn't see any strength out of the Gulf basis. But what we have seen is serious strength out of barge rates, and that puts negative pressure on river markets. Here you can see on the red line that barge rates are well above the 3-year moving average of what we typically see around this time of year. What's happening is, because we're getting into harvest a little bit sooner than we typically do, you add that, you add the into the equation that before the hurricane we had water levels along the Mississippi too low, we couldn't get barges down. We were shut down during the hurricane because it was just too wild down there. And now, of course, we have earlier harvest. Well, that's all putting a spike to these barges early on, and that's putting negative pressure. The final, I think, nail in the coffin here and is the forward curve. And we're going to look at the cash forward curve. You know, a lot of people, everyone looks at the futures market, but you can see, and you look at the futures market, there really isn't any carry whatsoever. But in the cash market, there is a carry. There's a 9-cent carry. It's a crappy carry. It's nothing that's going to make a producer really excited about storing beans to January. But the bottom line, there is a little bit of a carry. But I don't think that it's enough. I don't think that this carry that we're seeing in the market is enough to help alleviate basis. You know, right now we've seen basis decline very sharply in the spot months. I think that people are going to be selling off the combine, and the fact that we have such a very weak carry going out to January will cause basically an extended period of depressed basis that we're seeing right now. So don't look for soybean basis to improve here in the next couple weeks.
Right, certainly. Well, if you have any questions about basis in your local area there, certainly give us a call here at the office and we can help you out. I think that kind of wraps up our show here for Friday afternoon. Thanks a lot for joining us here on GrainTV. Have a great weekend. We'll see you back here on Monday.